I think actually the banking sector is holding up pretty well. We've clearly got some challenges, but at the end of the second quarter, 98% of banks were well capitalized, representing 99% of all bank assets. We had about 117 banks on a troubled bank list, those with very low supervisory ratings and representing only about $78 billion of assets. So that number is going to go up. Banks are increasingly facing challenges, and as the credit crisis morphs into more fundamental economic problems, and we'll see more traditional credit distress, that's going to challenge banks even further. But I do think it's worth noting that banks so far are faring pretty well, and a lot of the troubles we're seeing and the high-profile assistance that has been required has been for non-banks. It's not been for insured depository institutions. And so I do think that it underscores somewhat one of the lessons learned on this going forward is that there is some virtue to regulation. There is some virtue to leverage constraints, things like the leverage ratio and strong risk-based capital standards, which the FDIC has long fought for. I think those are serving the banking industry well. And again, that's not to say that we don't have challenges. We do. But overall, I think it's one of the reasons why insured depository institutions are in relatively stronger condition than other parts of the financial services sector. We, of course, also started expressing concerns about the housing market quite some time ago and called early on for restructuring, systematic, widespread restructuring of a lot of unaffordable loans that had been originated. Met with some mixed success of that, but I think we still plug away at it. And now that we're a conservator for IndyMac, we have a chance to develop our own model, which I think is going along quite nicely. And I think we'll talk more about the Treasury plan, but I think the Treasury plan will also offer some opportunities to get widespread restructuring of some of these unaffordable loans. But the cause of our economic distress continues to be driven by housing. And I continue to think that attacking the core of the problem is by restructuring these mortgages. And so we're hopeful that as Congress moves forward with the Treasury plan, that this is going to be the purchase and restructuring of whole loans, or perhaps some type of guarantee program will be a feature of that. We have about $45 billion in our deposit insurance fund right now. There's a lot of focus on that. That's our industry-funded reserve. We think that will be ample to meet, even in high loss scenarios, the internal stress testing we do in terms of bank failures that might be coming our way. We are going to be raising premiums in early October, not shockingly so, but significantly so, shall I say. We do think it's important to continue to rely on our industry-funded reserves to certainly cover our losses and hopefully meet all of our working capital needs as well. Though there has been some confusion and some misunderstanding of what the industry-funded reserve is. It is just that an industry-funded reserve, it is not the only resource we have to fall back upon. We are a government agency. We are explicitly backed by the full faith and credit of the United States government. We have long-standing lines of Treasury, wide flexibility to borrow from Treasury if need be, to fulfill our guarantee, though I don't think that's going to happen. Hank's got enough other people knocking on his door. I'm trying very hard not to knock on his door as well. So we're going to try to do it, and I'm sure the banks will be very happy on October 7th when we vote. We put our proposal out for increasing premiums, but I think it will be at a level that the industry can absorb. Again, there's a lot of excess capital in the banking industry, and we want to keep it that way. We think things like Section 23A that inhibit the ability of affiliates to use insured deposits for higher risk activity outside the bank is very important to continue stringent enforcement of that. Obviously, maintaining our leverage ratio. It's with all the problems with the various risk-based capital systems out there right now. I think our leverage ratio has again been an important constraint and has helped keep banks healthy. So overall, I think the deposit insurance fund is strong, the FDIC is strong, and the banking industry overall is strong, though there were clearly individual institutions with challenges, and we will deal with those as they come our way.